us to look at key things, key things under this topic, apart from cost of capital, apart from advanced financing decisions. They want us to look at what we call bond refinancing, rights issue, and then number 3, lastly, they would want us to look at this concept of buy or leasing. Very, very common in our exams. And if you check the handout that has been sent, I hope it has been sent. I would want us to go to page number 40 of that handout, which has been sent on your WhatsApp group. On your WhatsApp group, I want us to go to page number 49. Has it been sent? So we shall overcome. But I will read slowly as you try. Yes. No. It is still the old one. But you're doing, in this case here, what we call bond refinancing. Bond refinancing. You can look at your syllabus. There are 3 key things here. So we have bond refinancing. Bond refinancing. I will be able to read very slowly in a way that you'll be able to follow. It's not there. It's in there. It has been updated. So bond refinancing or refunding, don't write, occurs when a company retires an existing bond issue and replaces it with a new one, typically to take advantage of lower interest rates. So you must have heard of the government of Kenya talking about refunding of bonds. So before this expensive old bonds mature, before maybe you've taken a 20-year loan bond, and then on the 10th year, you realize that there are people who can give you the same money using these very bonds, but in this case here at a lower interest rate. So what do? You'll be able to refund the old bondholders, and then you issue out new, cheaper bonds. That is what we call bond refinancing. Bond refinancing. So then I'll be able to answer that question. But before I answer it, what are the reasons for bond refinancing? The most important reason for bond refinancing is reduction in financing cost. The interest cost will go down. Removal of restrictive covenants. You know, there are bondholders who will, for example, come and tell you that the moment we give you money, the moment you are bonded, we have these covenants. So in this case here, for example, you can't sell this land, you can't do this and this, you can't start this kind of new branches, because most bondholders, they fear increased risks. So then when I'm continuing, all right, I've taken a bond of say 10 billion from these bad bondholders who are giving me 1 million and 1 conditions. If I get somebody who is willing to give me even the same interest rate bond, but in this case here with softer conditions, I can easily do what? Retire the old bond. I can easily tell the old bondholders, take your money prematurely, and then I get new people to give me money. So removal of restrictive covenants. Use of idle cash. If you realize in this case here that you have got some 20 billion somewhere lying idle, then what should you do? And you happen to be having bonds. You happen to be having a loan. Retire that old loan. All right. So for us to be able to understand what we are talking about, I would want us to look at December 2024. December 2024, question number 4C. December 2024, question number 4, cow. December 2024, question number 4, cow. December 2024, question number 4C. Meanwhile, I would want to ask and know whether you have gotten the question on WhatsApp. So please take time to open, go to page number 49. Page number 49, I would want us to revisit. You can now check, it is there on your WhatsApp. Page number 49, it is there on your WhatsApp. Actually, page 48, eh? Page 48. Down there are pages, eh? There are pages down there. You're not able to get it. There are page numbers down there. We shall overcome, right? We are overcoming. All is well. Key cash flow components in bond refinancing. So whenever we talk of bond refinancing, what are the key concepts which I would be using to solve this question? Number one, we have what we call premium on refund. When you are retiring these old bonds, when you are repaying back these bondholders, the old bondholders, they will tell you, hey, you've retired our money prematurely. In this case here, give us a premium. Just like in most mortgages. Most mortgages, they'll always tell you to pay them something up. Yeah, more, additional, just in case you want to pay the mortgage earlier. So we have here what we call premium on refund, what we are calling the call premium, paid to bondholders for early redemption. Yeah. Then we have what we call overlapping interest charges. How does this work? Overlapping interest charges. Now, ladies and gentlemen, when you want, in this case here, to retire an old bond. So we have this old bond that is supposed to go up to 20 years. And then in between here, year number 10, the 10th year, you realize, hey, now I've gotten, in this case here, a cheaper bond. So what am I supposed to do? I'm supposed to look for these new people to give me cheaper money. So then what will happen is that, for example, here on year number 9, I will issue these new bonds out. When I issue the new bonds out, I start getting, in this case here, new cash. But you see, this new cash is the one that I'll be using to refund these old people. So it means that there will be a period when you will be paying interest for the old bond and when you will be paying interest for the new bond. We call it overlapping interest period, because I want you to listen to me very carefully. There is no way you can say that now, Mwalimu, this is year number 10. I'm going, in this case here, to return all the money to the old bondholders. When? You must get this new money quite earlier, like 2 months, 3 months. So during these 3 months, when you are processing to repay the old bondholders, you are paying 2 interests. We call this one the overlapping interest period. Overlapping interest period. Very, very important. And then, ladies and gentlemen, we happen to be having this one, which we call discount on issue. Every time you are selling bonds, you must give out discounts. Every time, in this case, you are selling bonds, there will be flotation water costs. And then, of course, you shall be saving interests between the two bonds here. So then let's go to December 2024, question number 4, cow. Once you get that question, are you able to say there, yes, yes? The online ninjas, have they gotten the question, yes or no? The online ninjas, yes. So then we read it together. Let's read this together. We read this together. So you're told ABBA Limited has a 20-year, 14% debenture worth 250 million, which has been in operation for the last 10 years. ABBA Limited still has in its books issue costs amounting to 900,000, being half the total amount originally capitalized. This debenture can be paid off at this debenture can be paid off. Yeah, this debenture can be paid off at any time, but the financiers will charge a penalty of 9% of face value. The directors of the company are considering replacing this debenture with a new 10%, a little bit cheaper. You can see the old one was 14%. This one here is what here? 12% debenture, whose face value will be still the same amount. The issue cost will amount to 10% of gross proceeds. The company, we are told, is in the 30% tax bracket, and there will be an interest overlap for how many months? 3 months. Required, they want us to give them the net cash investment that will be required to replace the existing debenture. Very, very easy. So right there, the net cash investment. Right there, the net cash investment. Net cash investment. The net cash investment. So net cash investment, which is the same as what here? Initial outlay. Initial outlay to enable refinancing. To enable refinancing, we have what we call the initial outlay. Here you will always be forced to remember what we call 𝐂𝐈𝐅𝐀. 𝐂𝐈𝐅𝐀 like this. 𝐂𝐂𝐈𝐅𝐀. 𝐂𝐂𝐈𝐅𝐀. So 𝐂𝐂𝐈𝐅𝐃, this of course is the call penalty premium. The call penalty premium. We have the overlapping interest. Overlapping interest. Overlapping interest. We have discount on issue of new bonds. New bonds. So we have the issue costs. Issue costs of new bonds. These are also known as what here? Flotation. Flotation cost. Flotation cost. So 𝐂𝐈𝐅𝐃. It's a very, very important mnemonic. 𝐂𝐈𝐅𝐃, like this. 𝐂𝐂𝐈𝐅𝐃. 𝐂𝐂𝐈𝐅𝐃 like that. So call penalty premium. We have overlapping interest. So as we shall see, these two are for the old bonds. Old bonds. These two old. This will be new, and this will be new. Okay. So then let's move with speed, my good students here. We start right away with the call penalty premium. Are you able to see any premium that will be paid? Any premium that shall be paid for early redemption? For early redemption? Any premium that will be paid for early redemption? Sorry, yeah. Remember, mine today is to simply talk and listen to you. I'll be listening more. I want to hear from you. Anybody who is able to see where we shall be penalized? 9%, isn't it? The last line of the first paragraph. We are told this debenture can be paid off at any time, but the financiers will charge a penalty amounting to 9% of face value. And what is the face value? 250 million, isn't it? The face value is 250 million. The face value is 250 million. You lose that, all of it at once. 9% of 250 million. Please give me a figure. I write down. Please give me a figure. I write down. So whenever they give 25, 500,000. Thank you so much. Then we go to the overlapping interest. Overlapping interest. So overlapping interest, is there somebody who is able to see the interest of the old bond? Interest of the old bond. Because remember, the two are normally for the old bonds. So rate of interest for the old bond is 14%. So I will take 14%. over 250 million, isn't it? But remember, the overlap is not for a whole year. The overlap is for how many months? The very last paragraph, it is 3 months. It is 3 months. So times 3 over what here, somebody? Times 3 over 12. Times 3 over 12. Which in this case here will end up giving us a what figure? I'm being given by J, 8750. 8750,000. Thank you so much. So then in this question, there wasn't anything to do with us trying to talk to the new bond holders to, accept taking our bonds by giving them discounts. This question does not have any discounts. So in the discounts, please put a dash there. But we happen to be having issue cost of the new bond. Is there anybody who is able to see the issue cost of the new bond? So issue cost of the new bond, we are told, ladies and gentlemen, is 10% of the gross proceeds. So in this case here, we have 10% of the gross proceeds, which are 250 million. 250 million, 10% of that. 10% of that, 10% of that. 10% of that. Yeah, so this gives us what here, somebody? 25 million, right? 25 million. Now from there, ladies and gentlemen, you come and less tax benefits out of this entire exercise. You less tax benefits. Tax benefits. Less tax benefits. So for tax benefits, because most of you hate KRA, yeah, you use this bad. Yeah, we talk of 𝐂𝐈𝐅𝐿. Yeah, 𝐂𝐈𝐅𝐿. Anytime we talk about tax benefits, because it goes to KRA, always use that acronym 𝐂𝐈𝐅𝐿. Yeah. So in this case here, we have a call penalty premium. So I can again write here for your revision. So this is call penalty premium. Then we have overlapping interest. Overlapping interest. And then we have unamortized. Unamortized discount. Unamortized discount. Then we have unamortized. Unamortized. Yeah, issue costs. 𝐂𝐈𝐅𝐿 for KRA. You make that bad sound to them. 𝐂𝐈𝐅𝐿. Yeah, so in this case here, of course, you have these figures. Are you able to see the call penalty premium? It is 22,500, isn't it? Yeah. Do we have in this case here overlapping interest? Overlapping interest, already this one here is here. 8750. Unaandika kando kabisa kwanza, because we'll be multiplying this with 30%, andika kando kabisa. So an amortized discount, this question does not have anything to do with the discount. So then we have an amortized issue cost. For the, when it is an amortized, it means for the old bond. Everything under here is for the old bond. Everything. Old bond. Old bond values. So is there somebody who is able to see an amortized issue or an amortized flotation cost? An amortized issue or an amortized flotation cost? How much? 900,000, right? 900,000. The online ninjas haven't spoken to me regarding that. An amortized issue cost or an amortized. Yeah, they haven't spoken to me regarding that. Are they able to see an amortized? It is given there. You can see line 1. ABA Limited has a 20-year, 14% debenture worth shillings 250 million, which has been in operation for the last 10 years. ABA Limited still has in its books issue costs amounting to 900,000, being half the total amount originally done what here, somebody capitalized. You see, ladies and gentlemen, the total capitalization cost in this question is supposed to be 1.8 million. But we are refunding this bond after how many years? After 10 years, I mean. It's a 20-year bond, but down the line, 10 years down the line, we shall be amortizing it. We shall be selling it. We shall be retiring it. So, and that is why you can see here in our books, we have been able to capitalize. We've been able to expense. How much here, somebody? 900,000. So the unexpensed one. The unexpensed one moving forward after these, what we are calling unamortized or uncapitalized. It's given in the question. Line number 2, ABA Limited still has in its books issue costs amounting to 900,000 being half the total amount originally done what year? Capitalized. So in this case here we have 900. So please take 30% of each one of these. 30% of each one of these. Give me answers. Give me answers which you shall be able now to write here at the corner. At the very corner. So 22,500,000 times 0.3. Please give me an answer. Quite an ugly figure, right? 67? Not ugly. Very good. So it's a tax benefit against expenses, So we deduct it. All these are the tax benefits we shall deduct. How about 87,50,000 times 0.3? Times 0.3. 26,25,000, 26,25,000. Lincoln, I can see your question. We don't divide by 20. No, this is full. The full unamortized. The full unamortized. This one here is 0, right? Yeah. 900,000 times 30%. Times 30%. Which now will end up giving us 200 what year? 70,000. 270,000. So at the time of you doing this redemption, you must be having this initial outlay. You must be having this initial outlay. How much do we have there? You must be having this initial outlay. How much are we talking about? So you take this plus this plus this minus this minus this minus this minus that. You give me an answer. That is the initial outlay. So you remember Cody, who goes hand in hand with what here? 𝐂 for tax benefits. For 𝐂, together with 𝐂 for tax benefits. For tax benefits. So how much do we have there, my friends? So they're giving me quite a nice figure. 46,605. 46,605,000, Yeah. So this is really a very, very important question that I would always want you to revise, I told you should always be revising what we do in a class. What we do in a class. Is that okay? Yeah, thank you so much. Then now we can comfortably go to number 2 of this question, where they want us to give them the annual cash benefit to be derived from refinancing the current debenture. The savings, basically in terms of interest. Yeah, so if you allow me, I'll be able to rub this, If you allow me, I'll be able to rub all this. So can I rub all this? Okay. Thank you so much. Thank you so much. Thank you so much. So then we shall be able to proceed. Ladies and gentlemen, we shall be able to proceed. We shall be able to proceed. We have here number 2. Number 2. Annual, annual cash benefits. Cash benefits or savings. Annual cash benefits or savings. So then here we shall be able to compare 2 bonds, Old bond, new bond. That's what you do. That's what you do. So old bond versus new bond. All right, my good students. So of course, the differentiating feature here will be the interest. So don't forget everything here has to be annual, Annual, per annum, annual. So interest, we start with the old. So remember the old, it's 14% of the 250 million. The new, is there somebody who is able to remember the new interest? 12%, the amounts will always be the same of 250 million. Please give me these numbers I write there. The first one I'm being told is 35 million. I forgot your names. Did you ever to tell me your names really? What I know is Mwanarusi. That one I'll never forget. You say Sahau. Your name is Ivy or Irene? Ivy, you say Sahau. You got 35 million, eh? How about the new bond? 30 million, right? 30 million. 30 million. Thank you very much. Thank you very much. Aha. The interest. You know, we have the rates of interest, right? Are you able to remember the old bond was 14%? 14% of the total amount, total loan. Initially, we got. Ask questions. I'm always happy to help. Always happy to help. You divide it, or don't divide. Initially, don't divide. Because if you divide by 12 or whatever, then we'll be getting, you know, this is 14% is per annum. Every year is per annum. All right. And then now you less tax benefits. Tax benefits. Don't forget these are annual benefits. Annual benefits. These are annual benefits. So these annual benefits, ladies and gentlemen, we normally use the concept of what here? Feed like this. Or you know, ever to forget this, feed. So in this case here, this feed, we have the first one. So we have the first one. Yeah, let me just repeat this. This is F for flotation cost. Flotation cost, which is the same as what here? E? Issue costs. Don't forget that. And then we have I for what here? Somebody interest? Interest, yes. I for interest. And then we have this D for what? Discount. Discount. D is for discount. Discount. So then we shall start with issue cost, and I have to rub mine because of space, eh? Yeah, so issue cost. So is there somebody who is able to see the issue cost for the new bond? New bond? The issue cost for new bond? Issue cost for the new bond. Yes, 𝐂 is for the old bond, always old bond. 𝐂 is for the old bond. Issue cost J for the old bond for sure is not 25 million. No, no, for the old bond. Yes. Yes. The new one is 12%, yes. You see, it's just like, for example, if you take a loan today, you've taken a loan of, say, how much? Say 10 million, right? But interest is 10% per annum. Even if you have to pay that loan, even 30 years, every year they're taking 10% of the 10 million. Yeah, then next year, maybe 10% reduced balance. So when you say, you see that 12% is for a whole year, 12% per annum. Yeah, that's for a whole year. You want us to divide this by 20 or by 10? For the new one, eh? You see the new one, this 12%, let's get it clearly. Yeah, good questions. So we are told here, the directors of the company are considering replacing this debenture with a new 10-year, 12% debenture with a face value of what here? 250. Of course, they haven't told you, but that 12% must be an annual rate. Yeah, nobody will ever give you a loan of 12% interest for a whole 10 year. That is 12% per what year? Per annum. It's 12% per annum. 12% per annum, yes. Again, you see, if, for example, you are to divide this by 10, so you start paying 3 million, all right? And you are paying initially 35 million. When the deal is too good, it can't happen, that one. You save all that money, 35 million to 3 million. It cannot happen, all right? So then let's get now the issue costs. So issue cost, what do we have here? Old, here is where we are not agreeing now. The old one, the issue cost, old one. You can see we are told up there, sentence number 2, that ABA Limited still has in its book issue costs amounting to 900,000, being half the total amount originally capitalized. Being half, isn't it? So there are two ways. So it means that this issue cost for the old bond, let me start with the old bond. Old bond here. It is 900,000. Yeah, and they have been able to capitalize this. And remember, by the time we are capitalizing everything, how many years have lapsed? Yeah, we have stayed with this bond for how many years? 10 years. So I can easily get, in this case here, the issue cost per year. Alternatively, this 900,000 is a half. So I can easily get full, which will be what here? 1.8 million. But now I divide by the full period as well, which is what here? Which is 20. So it will be me to decide here. Let's read this. We are told ABA Limited has a 20-year, 14% debenture worth 250 million, which has been in operation for the last 10 years. So for the last 10 years, we've been operating this. And for the last 10 years, we've been able to capitalize 900,000. The very best way is to appreciate that the 900,000 is for 10 years. How about the issue cost per year? So it will be 900,000 divided by what year? 10. Because we are talking about everything is what year? Annual, Everything is annual. So don't write inside here. You simply say this is 90 what year? 90,000. 90,000. How about new? How about new bond? Yeah, new bond. So for the new bond, they have told us, ladies and gentlemen, the new bond, they have told us in the last paragraph. They have told us in the last paragraph. Yeah, the directors of the company are considering replacing this debenture with a new 10-year, 12% debenture whose face value is 250 million. The issue cost will amount to 10% of gross what year? Proceeds. So in this case, it will be 10% of gross proceeds of 250 million. But now you have to be very, very good here. Remember, flotation costs and any issue cost, ladies and gentlemen, and any discounts, they are normally amortized evenly over the entire life. So this 10% of the 250 million is the total issue cost for how many years? For 10 years. You know, the new bond is going to stay with us for 10 years. It's going to stay with us for 10 years. So can you kindly give me this figure? Kindly give me this figure. How much are we looking at? How much are we looking at? 2.5. 2.5? 2.5? Are you sure? Because this will be 25. Yeah, 2.5 million, yes. 2.5 million. So can you kindly do me a favor, times 30%, because these are benefits. Times 30%, times 30%. Do me a favor, give me this 30%, 30%. Interest, yeah, we're coming back to it. First of all, we have begun with flotation cost. Thanks for asking. We have begun with flotation cost. We began with flotation cost. So the first one, I'm being given what amount? 30% of 90. 27,000, 27,000. How about 2.5 million times 30? 750. So this gives me 750,000, like that. Now, remember we said, here we are using the concept of feed, feed. Yeah, so we have begun with flotation cost. So this is over. From there now we go to the second one, which is what here, somebody? Interest, isn't it? Interest, which is interest. So interest, fortunately, we have the old bond, interest is 35 million. And then new bond, the new bond, the interest is how much here, somebody? 30 million. We are only interested in the tax benefit of the same. 30% tax benefit has been given. We are only interested in the tax benefit. Tax benefit of that. We are only interested in the tax benefit. So please give me the numbers. I'm really waiting for you. The first one, please give me the numbers. Old bond, 10.5. The old bond is 10,500,000. You subtract. How about the new bond? 9 million, eh? The new bond is 9 million here. The new bond is 9 million there. Thank you so much. From there, ladies and gentlemen, we have the concept of what a discount for this, which discount, of course, is 0 versus what here, somebody? 0. You don't have any discounts here. We don't have any discounts here. So then can you kindly go ahead and give us, in this case here, what we need to be paying? So the net interest per annum. The net interest per annum. So if it is the old bond, you take 35 million minus this, minus 10.5. You give me a figure. 35 million minus 27 million minus 10.5 million. Please give me a figure. 73. 2. 473,000. Thank you so much. Thank you so much. The online guys are not giving me numbers, and really, I'm looking upon you as well to give me these numbers. The net interest, 24. Thank you so much. How about net interest for the new bond? 20. 250. So are you saying with the new bond you are saving? So please give me the savings for the new bond. Give me the savings for the new bond. Savings. If we retire, if we refinance, if we go for this new bond, yeah, any question, please feel free to ask questions. I'm always happy to help. So savings, it is 473,000 minus 250,000, which will end up being equal to whom? 4 million. Okay, 4,223,000, like that. And remember, this is per what here, somebody? Per annum. This is per annum. So that is it. That is what they were asking you to do in Roman 2. In Roman 2. In Roman 2. Now, Roman 3, they want you to get net present value. Roman 3, they want you to get net present value. So Roman 3, they want you to give them the net present value. I would want you to go later on, revisit this question so keenly. If possible, watch the video again so keenly for you to be really perfect with this concept here. So Roman 3, they want net present value. So how do we get this? We know the annual cash flow. This is like the saving will be what will be your cash inflow for 10 years. So it will be 23,000. And because it's an annuity, we talk of PVFA. How many years are we going to enjoy this? 10 years, yeah, because the new bond now. 10 years. So what is the cost of capital here? 12 or 14? Or 10? Yeah, it is 20. Oh, I don't know whether I took it as 270,000. Yeah, was it? It was you see, it was 900,000, that flotation cost, but we divided this by 10, so we got 90,000 times 30%. That is how we got that 27,000. Thanks for asking. That's how we got the 27,000. Now, you see, this PV will be for 10 years. What is the cost of capital? The online ninjas, what is the cost of capital? It has to be the new debt, isn't it? The cost of new debt. So cost of capital will be equal to cost of new bond multiplied by 1 minus T, where it has to be after tax. Kikosa hiyo unanyoroshwa, cost of new bond less tax. And the cost of the new bond, you guys are crazily nice. You are saying it is 12%, isn't it? Times 0.7. 12% times 0.7, yes. So cost of capital for discounting purposes will be cost of new bond less taxation. So it will be 0.12 times 0.7, which will end up giving us what figure? 0.84, eh? Thank you so much, which is 8.4%. So 8.4%, we less the initial outlay. Less the initial outlay. So then let's first of all get that PV for ourselves. PV for ourselves. So let's get this PV for ourselves. Remember, the formula is 1 minus 1 plus R raised to negative n all over R. So it will be 1 minus 1.084 raised to negative 10. Everything divided by R itself, 0.084. Be careful with this. Be careful with this. I may not be very sure. Be very careful with this. So 1 minus 1.084 raised to negative 10. Whatever answer I get, I will come and divide this by 0.084. Divide this by 0.084. So tell us, what are we able to get at the end of the day? What are we able to get at the end of the day? Abracadabra. You shall never fear, even at your workplace. When people are very quiet at the meetings, you wake up and talk, isn't it? That's how you conquer. That's how you break the ice. So whatever you have gotten, even if it's zero, you just mention zero. And then other people will say no. But you see, at the end of the day, they will have given us the answer, isn't it? You have started the debate. That is the most important. So I'm being given 6.5907. 6.5907. So then come back here. So this will be 23,000 times 6.5907 minus the initial outlay. Is there somebody who is able to remember the initial outlay? We have done initial outlay in part 1, eh? Initial outlay in part 1, which is 46. Yeah, 46,605,000. So please go ahead and give us the NPV. If it's positive, then we are telling these people, come. Go for the new bond. The new bond is better. If it's negative, we tell them, no, old is gold. Stay with the old bond. Stay with the old bond. Stay with the old bond. So Lincoln says negative. I can't even write that figure. So long as it's negative, then in this case here, the company should maintain the old bond. The company should maintain the old bond. The company should maintain. It's minus 18 point something, isn't it? Yeah, very ugly figure, minus 18, 772,473.9. And because it's negative, we are saying that the company should abandon the idea of the new bond and maintain what here, somebody? The old bond. Old bond. They should maintain the old bond. All right. So what do you think of that approach of doing this question? Do you think later on, if you get time to go through it, just that question alone, don't even do any other. You just go and do that question alone. Do you think when you do that question now, when you will be on your own later on, do you think you'll be able to understand the solution? Yeah, that is the most important thing. Please ensure that you are able to understand the solution. I hope that is also applicable to these online ninjas. Yeah, if they refund, it means they go for the new bond. If they refund, it means that they go for what year? The new bond. Yeah, great. Thank you so much. So then let's go to this other smaller subtopic, which they have really stayed without testing. I wish I was an examiner. If I was an examiner this semester, I would have brought, still under advanced financing decisions, I would have brought the concept of rights issue. Rights issue. Rights issue. So right there, rights issue, and then we shall be able to continue after our short break of 10 minutes. It's important that we take a short break, especially when things become so hot. Yeah. So now we can continue, ladies and gentlemen. Remember, what do we have here? Yeah, rights issue. Everybody must have heard about rights issue. What's a rights issue? Shares being sold to existing shareholders at a discounted price. At a discounted price. We have what we call a bonus issue. Bonus issue, of course, here shares are being issued to existing shareholders, but for free. You're given shares for free. But under rights issue, then automatically you will be able to have, at the end of the day, you'll be able to have their shares. You as an existing shareholder, additional shares, new shares at a discounted price. So it's a method of raising additional capital by offering new shares to existing shareholders, usually at a price lower than the current market price. You as a finance manager, what do you think are the main reasons or purposes why you should always go for a rights issue? Yeah, we are going for a rights issue, of course, to raise capital, isn't it? Yeah, if we want to raise capital, yes. To pay our debts, yeah. We want to raise capital for new projects, to pay our debts. Yeah, very important. And I would want us to do the question that is on that paper. Now you have to open it. A very important question. Once we finish that question, then we shall be through with the class. Everybody shall be able to go home. Yeah, I know that is what like most, isn't it? That is what we like most, everybody. Sorry, we shall overcome. Really sorry, yeah. Marker Limited. Marker Limited plans to raise shillings. Marker Limited, the plans to raise 20 million through a rights issue to fund an expansion water project. Is what in the past paper? It's in the handout that I've sent. The handout that I've sent, and if you don't have it, then I'll be able to summarize the figures. The handout that I've just sent, if you go to page number what? Number 49. If you go to page number 49, Gabriela. Marker Limited. You can just listen and I'll be able to just highlight everything. That we want to raise how much? 20 million through a rights issue to fund an expansion project. The company currently has 2.4 million ordinary shares trading at shillings 30 each. The rights issue price is 25 per share. You can see the normal market price is 30, but the rights issue price is lower, is 25. The expansion is expected to generate annual net cash inflows of 6 million for 5 years and a salvage value of 5 million, and the cost of capital is 12% per annum. So you can just summarize this by writing down this table. You can just write down this table as an exercise. We say funds required. Funds required. How much do we require in total? 20 million, right? We require 20 million in total. existing shares. Existing shares, they have told us are 2.4 million. Existing shares, we have 2.4 million. Then we have current market price per share. Current MPS is 30. 30. Current MPS is 30. Then we have rights issue price. Rights issue price is 25. Annual cash inflow. Annual cash inflow. We have 6 million for 5 years. For 5 years. Annual cash inflow, 6 million for 5 years. We have a salvage value. A salvage value of 5 million. Salvage value of 5 million. Then we have a cost of capital of 12%. Cost of capital of 12%. Cost of capital of 12%. So let me know once you guys are able to copy that. Thank you, they are finished. So the first question that they want us to do, they want us to give them the 𝐂𝐈𝐅𝐿 market price per share. Look at the first question. Look at the first question. They want us to give them the current 𝐂𝐈𝐅𝐿 market price per what year? Per share. Very easy. Very easy. Yeah, so 𝐂𝐈𝐼𝐅𝐿 price. Yeah, 𝐂𝐈𝐼𝐅𝐿. No. Let's read this very well. What do they want us to give them? There is a repetition there. So 𝐂𝐈𝐼𝐅𝐿 MPS there. Yeah. 𝐂𝐈𝐼𝐅𝐿 MPS. 𝐂𝐈𝐼𝐅𝐿 MPS. So it is 𝐂𝐈𝐼𝐅𝐿 market price per what year, somebody? Per share. So then this 𝐂𝐿 means what? The 𝐂𝐿 in this case here means what here? With. And we have X. X means without. And the 𝐂𝐿 means what here? With. This 𝐂𝐿 means with. So if we are acquiring a share today and its market price per share, for example, is 30, but you're told in this case here that whatever amount that will be raised out of these shares that will be sold, we are going to invest in a project. And this project will be able to give us some cash flows here. All right. So it means that you as a new buyer, when you are considering buying this share, you should be able to know that this share is coming pregnant. Yeah, coming pregnant. It has, in this case, here, some fruits, which will be able to harvest more than what the existing shareholders are getting. So then how do we get this 𝐂𝐈𝐼𝐅𝐿 MPS? It's very, very easy. To get this 𝐂𝐈𝐼𝐼𝐅𝐿 MPS, what we normally do is to take the current MPS, you add the NPV per existing share, Because whatever will be raised out of whatever you're going to issue here, you're going to invest the same in a project. And the project will be able to give you some fruits, which should be able to boost the existing market price per share. So then I would want us to calculate this net present value. So the net present value, we know that the project we are getting will be giving us an annual cash flow of how much? 6 million, isn't it? And this is an annuity, so times PV-FAR. PV-FAR, remember they have given us cost of capital, 12%, isn't it? For how many years? 5 years. Do we expect any other cash flow apart from this annuity? Scrap value, isn't it? We have scrap value. We have scrap value. Salvage, yes, or scrap. So the salvage, so plus 5 million. And remember, this figure will only be coming once. So this once is what we call PV. PV, isn't it? Yeah, 12%. How many years? Minus the initial outlay. Are you able to see the initial outlay? How much will we need for this project? How much do you want to raise? 20 million, isn't it? That is the initial outlay. Because you are raising 20 million to finance this project with this cash flow. So 20 million. So then are you able to give me the PV-FAR in this case? Let me try you out. Anybody who is able to give me this PV-FAR 1 minus 112%, isn't it? 1 minus 1.12. Yeah. Raised to -5. Everything divided by 0.12, which will end up giving us a what figure? Remember the formula of PV-FAR. I know now you are experts, eh? I know right now I'm teaching experts. So 1 minus 1.12 raised to -5, and then everything we divide by 0.12. We divide everything by 0.12. And what did we say about the Sunday class? We need to just be very nice and come like one Sunday so that I can get to finish the mergers. The remaining topics now are very, very light. Once I finish this, the remaining topics are very light, very light. So somebody's giving me a figure of 3.6048, 4 decimal places, right? 6048. How about PVIF? So PVIF, it will be 1.12 raised to -5. If you remember the formula. PVIF, if you remember the formula, it will be 1 plus R raised to -n. So 1.12. Yeah. Thanks, Peggy. Thanks, Jane. Thanks, Margaret. 5674. Thank you so much. So then can you kindly then go ahead and give me this net present value? Give me this net present value. I'll write it up here for lack of space. So then my net present value will be equal to the 6 million times the PV-FAR times 3.6048 plus 5 million times 5674 minus 20M, because we want to raise 20 million. So then how much are we going to get? Somebody already has an answer. Somebody already has an answer for this net present value. So the net present value, I'm being given a figure here of 44,800, isn't it? And remember, I want NPV per existing share. NPV per existing share. It will be 44,65,800 divided by what here, somebody? 2.4 million. Yeah, thank you. 2.4 million. We have 2.4 million existing shares. We have 2.4 million existing shares. Please don't forget, it's about NPV for each existing share, which gives me 1.86. 1.86. 1.86. And therefore, they come rights. With these rights, they come rights. NPV will be equal to, what is the current market price per share? Yeah, it is 30. Current market price per share is 30. So you take 30 plus 1.86, isn't it? Which will end up giving me 31.86, like that. Please don't forget this. If they tend to bring it this semester, this one, very few students will be able to get it right, but fortunately, you'll be among those few students. So up to there, ladies and gentlemen, are we really together? If I'm the one looking at this kind of a question, even without knowing what is being asked, I can easily end up giving some sort of an answer. Because I'm able to see cash flows. I'm able to see, in this case here, cost of capital. I'm able to see initial outlay. So even if I don't know what I'm doing, I'll go up there. In number one, calculate the net present value. Then I go to number two, again, I'm repeating the same net present value. Number three, I repeat the same net present value. At the end of the day, you end up getting some marks which you would have not gotten if you decided to hand over a blank sheet. So then that is okay. Allow me to go to the next question. So the next question, what do they want us to do really in this next question? They want us to give them the number of rights required to buy one new ordinary share. Write it as a title. Write it there as a title. Number of rights required to buy one new ordinary share. How many rights do we need to be able to buy one new ordinary share? How many do we need? Abracadabra. How many do we need? How many shares do we need? How many rights do we need to buy one new ordinary share? So how shall we be able to do this really? How shall we be able to do this really? The first thing that I will do is to calculate new shares, number of new shares. Number of new shares. Mention there, number of new shares. Number of new shares. Number of new shares. Number of new shares. So number of new shares, very easy. New shares. You basically give us, in this case here, the funds required. Funds required over rights issue price. Over rights issue price. How much do we need in total? 20 million. You told me that, isn't it? 20 million. And are you able to see the rights issue price, my good students? How much do we need? 2,000? No. 20? Nope. Nope. The rights issue price, 25. The rights issue price is 25. Yeah. So please go ahead and give me, in this case here, go ahead and give me, in this case here, the new shares. 8,000? 80,000 uongo, tumia calculator. 800,000, isn't it? 800,000. 800,000. 800,000, like that. So then after you get this, then you should be able to give us the number of rights. You should be able to give us now the number of rights. How do we get number of rights? Very easy. Easy peasy. How do we get number of rights? So we are told here, number of rights. So this number of rights, we also call this one here rights ratio. Rights ratio. How do we get these? To get rights ratio, we normally take existing number of shares, existing number of shares, all over new shares, new number of shares, new number of shares. So existing number of shares, how many are they? Existing number of shares, how many are they? 2.4 million, isn't it? So we have here 2.4 million. Yeah, divided by new number of shares that you've just gotten here, which are? So this means here 3 rights. Yeah, 3 rights for 1 share. 3 rights for 1 share. So basically, this is a 1:3. A 1:3 rights issue. A 1:3 rights issue. A 1:3 rights issue. Help me interpret this. Help me interpret this. So how many new shares shall we give you for how many shares that you have? 1 new share for 3 old, isn't it? Yes. It can never be the other way around. The farm will die. You can't have like 1 old share and then you are given 3 new. Where? I'm surprised you guys are really good. So whenever you see this 1 to or even 3 to 1, it means that for every 3 old shares you have, you get 1 new share. You get 1 new share. If you have so many new, it will lead to what we call diluted ownership. And nobody would want that. Nobody would want that. This board was not visible. How comes the online students never told me? Remember, we are producing these videos for our great-grandchildren, and we don't want them to come and curse us later on. They should be able to see everything. Those great-grandchildren, just try to imagine how they shall be looking like. They will not be your usual kids, isn't it? Those people around here who happen to be having teenagers, you know how it is outside here, isn't it? It's not easy. It's not easy. Then you look at Roman 3 of this. Roman 3 of this, or Roman 2 is over. So Roman 3 of this, what do they want us to give them? They want us to give them theoretical X rights price, isn't it? Theoretical, I love this. Theoretical X rights price. Theoretical X rights price. So is there somebody who can give me this theoretical X rights price? Now remember, with this one here, we normally abbreviate it as TERP. We normally abbreviate it as TERP. Theoretical X rights price. We normally abbreviate this as TERP. Yeah, so this is normally very, very easy. To get TERP, what do we normally do? We normally take PO, SO, yeah, plus PN, SN, all over SO plus SN. So remember, SO represents old shares number, which in this case here are how many? 2.4 million, right? Now they are not talking to me, but we shall overcome, right? We shall overcome. Then we have SN, new shares, right? New shares, its number. You guys gave me a figure of 800 what year? 1,000. PN, new issue price. New issue price. Do you remember the new issue price? Yeah, 1 point? No. Remember the issue price is the rights issue. The lower one, 20? Are you able to remember that 25? Yeah, sorry for that, 25. The new issue price. Yeah. So in this case here, the brother is quite nice because he has known that this PO stands for the old market price per what year? Per share. The old market price per share. Rights issue, yes. Rights issue, yes. So please give me this old market price per share. Now you're very, very quiet. Shall we be able to finish this class nicely? Be nice to me as we finish. 30. Remember that 30 figure? Now that 30 figure has been overtaken by events. So remember that this old market price, because of a new venture that is ahead of us, now we are getting a share that is pregnant. We call it what here, somebody? Come, never forget that. So it has to become rights MPS, which was 31 point what here, somebody? Yeah, if you confuse this, international desire, was it 31.86 or 81? 86 like that, 86. Now substitute theoretical X rights price. Theoretical X rights price. Theoretical X rights price. Thanks, Margaret. Theoretical X rights price. So now we are substituting like superstars. We are substituting like superstars. We are substituting like superstars. Yeah. So PO, we have here 31.86 times SO, the old one, is 2.4 million plus PN. PN is 25 times, ladies and gentlemen, SN, old shares, they are 800,000. Divide this by SO, which is 2.4 million, plus SN, which is 800,000, like that. So then are you able to give us the final answer? Please, abracadabra, do your abracadabras and give us the final answer. Do your abracadabras, tiny. You have a very, very unique name, time. So they're giving me a figure of 30.145, 30.145, 30.145, 30.145. Are they able to get that 30.145? But a good student will never do this question this way. A good student, especially those students that I taught myself in financial management, if I taught you in financial management, I'm so sure you can't do this question this way. This is an old style, bad style. In this case here, the better style is you to remember the rights ratio. Remember, our rights ratio is 1 is to what? So 1 new for every 3 what year old. So 1 new, this is the rights share, which is going for 25. These 3 old are the ones in this case that are at a price of 30, but because of the 𝐂𝐈𝐅𝐿, it became 31 point what here, somebody? 86. So could you kindly multiply? So 1 times 25, this gives me 25. How about 3 times 31.86? 3 times 31.86. 95.58. Thank you. So total 25 plus that 95.58, 120.5. For how many shares? These are 4 shares. 4 shares at TERP. 4 shares at TERP. Yeah, the price we'll get is what we call the theoretical X rights price. So meaning that the TERP, if you make the subject of the formula, it will be 120.58. You divide this by how many shares? By 4 shares. 120.58, divide this by 4 shares. Shall we get the same answer? Which method should we work with? The second one, isn't it? Because here you don't have to cram formula. You don't have to cram the formula. Lincoln is asking whether they'll give you full marks. If they won't give you full marks, I would have warned you, I would have told you use the first method. Whichever method you decide to work with, you stick with that one. You stick with that one. You stick with that one. Let me see whether we have some small energy to do the next concept there. So we have here the theoretical X rights market price, TERP, that we have done very, very well. Now from there we go to this theoretical value of each right. Value of a right. Value of each right. How do we get value of the right? Very easy. How do we get value of the right? How do we get this value of this right? To get value of the right is a very, very small formula. You simply take PO minus PX. So anytime they want you to get value of a right, whenever they want you to get value of a right, we shall always take PO minus what here? PX. So PO, remember, is the current market price. PO is the current market price that is pregnant, the CAM. Don't forget that, which you guys have confidently told me severally. It is 31 point what here, somebody? 86. And this PX is X rights. This is what we call the theoretical X rights price term. That you guys comfortably gave me a figure of 30.145 like that. Yeah, so you go ahead and subtract them. So this is 31.86 minus 30.145, which will end up giving me what figure? That is a theoretical X rights price. Theoretical X rights price. So PO minus PX. And then PO, don't work with 30. PO shall work with a CAM. Never forget that. Never forget, because this is not your usual share. This is coming up with what here? Benefits. Ni ng'ombe na ndama yake. Iko ndama. Iko ndama. Iko ndama. Yeah, so they're giving me a figure of 1.715. And this is really a very 1.715. Yeah, so the value of a right is 1.715. So you as a shareholder, when you are given access to rights and then you do nothing, you'll be losing this amount per right, per share that you have, a right or per share that you have. So in our next class, you can see they want us there to look at, yeah, a shareholder who is problematic, Yeah, so they want us to evaluate the impact of the rights issue on the value of wealth of an existing shareholder who owns 1,200 ordinary shares in the company and has shillings 15,000 in his savings account. Are the various options available to him? What options do you think will be available to this gentleman? What kind of options do you think will be available to him? 3 of them. He can decide to exercise the rights. If he exercises the right, then he is purchasing the new shares. He can decide in this case here to say, I'm going to sell the rights because I don't have money. Yeah, so I sell all the rights. Or I decide in this case here to do nothing. So we shall be seeing in our next class, he can only lose if he does nothing. But either if he decides to sell his rights or he decides in this case here to buy new shares, the wealth will never be different. The wealth will always be the same. So it has been a pleasure hosting you this evening. See you as we discuss on our WhatsApp group. Bye.